If you are watching this right now and you still believe that the financial system we live under is stable, that your savings are safe, and that tomorrow will look like yesterday, then this message is exactly for you. Because what's coming isn't a correction, it isn't a slowdown, it's a reckoning. And the people who see it early don't panic, they prepare. For decades, you were told that gold was a barbaric relic, that silver was outdated, that paper promises, digital numbers, and endless debt were modern money. But history has a brutal way of humbling arrogance. Every single fiat currency system in human history has failed. Not some, not most, all of them. And today's system is not the exception. It is the most extreme version ever created. What most people don't understand is that the global currency system doesn't break all at once. It fractures quietly, internally, long before the headlines admit there's a problem. On the surface, everything appears functional, markets open, transactions clear, numbers move on screens, but underneath, the foundation is eroding. And once a currency system loses trust, no amount of printing policy tweaks or political reassurance can put that trust back together again. We are living inside the most debt-saturated monetary system in human history. Debt is no longer a tool. It is the system itself. Governments borrow to pay old debt, corporations borrow to survive, and Andons borrow just to maintain a standard of living that used to be normal. This is not growth, it's dilution. And every new unit of currency created steals purchasing power from every unit already in existence. That theft is invisible to most people, but it is relentless. Currencies are supposed to function as a store of value, a medium of exchange, and a unit of account. Today's fiat currencies fail at all three. They no longer store value because inflation is permanent, not temporary. They no longer function smoothly as a medium of exchange because confidence is eroding and settlement risks are rising. And they no longer serve as an honest unit of account because the measuring stick itself keeps shrinking. When money lies, every price signal becomes distorted. This isn't accidental. This system was built on promises that could never mathematically be kept. Endless growth on a finite planet. Infinite debt backed by nothing but confidence. The problem is not mismanagement. The problem is structure. You cannot fix a broken foundation by repainting the walls. And what we are witnessing now is the natural consequence of decades of monetary excess finally colliding with reality. Look at the global landscape. Nations are moving away from dependency on single reserve currencies. Trade agreements are being rewritten. Trust between governments is dissolving. Currency weaponization has accelerated de-dollarization, not stopped. When money becomes a political tool instead of a neutral medium, it stops functioning as money. That is a critical point most people miss. History is very clear on this. Every fiat currency system eventually collapses under its own weight. Sometimes slowly, sometimes suddenly, but always completely. The public never believes it will happen in their lifetime because the system is designed to feel permanent. Yet permanence is an illusion created by stability, and stability is already gone. The fractures are widening. You see them in inflation data that doesn't match lived experience. You see them in rising interest costs. Governments cannot afford. You see them in social unrest, political polarization, and financial volatility that no longer responds to traditional solutions. These are not isolated problems. They are symptoms of a currency system that has reached its limits. When confidence breaks, and it always does, money reveals what it truly is. Paper promises disappear. Digital numbers freeze, but value doesn't vanish. It moves, and it always moves back to what has survived severe collapse before. Most people look at rising gold and silver prices and assume something extraordinary is happening to the metals. They're told there's a rally, a boom, or a speculative surge, but that framing is backward. Nothing dramatic is happening to gold and silver at all. What's happening is the quiet, relentless destruction of currency purchasing power. When the measuring unit is failing, everything measured in it appears to rise. Gold does not go up. Silver does not go up. They simply sit there doing what they have always done, reflecting the value of what paper money has lost. That distinction is critical because once you understand it, fear disappears and clarity takes its place. Gold is not an investment in the traditional sense. It is a form of money that has survived every monetary experiment humanity has ever tried. When people celebrate new highs in gold, they are unknowingly celebrating the failure of their currency. A rising gold price is not a sign of prosperity. It's a warning light. It tells you that confidence is eroding, that promises are being broken, and that purchasing power is leaking out of the system faster than most people realize. This is why those who truly understand money don't chase returns. They preserve value. Currencies today are designed to lose value. That is not conspiracy. It is policy. Inflation is built into the system because debt requires it. Without inflation, debt collapses. With inflation, savers pay the price. Every time new currency units are created, your existing savings buy less. Slowly at first, then suddenly, the process feels manageable until it isn't. The real tragedy is that most people measure wealth in nominal terms. They see higher account balances and think they're ahead. But if the cost of food, energy, housing, and healthcare rises faster than wages and savings, then wealth is an illusion. Gold exposes that illusion. It doesn't manipulate, it reveals. Silver plays an even more interesting role. It shares gold's monetary history, but it also functions as an industrial necessity. That dual role creates a unique tension. When currencies weaken, monetary demand increases. When technology and infrastructure expand, industrial demand rises. Meanwhile, supply is finite and increasingly difficult to extract. That is not speculation, that is arithmetic. The idea that metals are volatile comes from pricing them in unstable currencies. If you measure stability with a broken ruler, everything looks distorted. In reality, gold has maintained purchasing power over centuries. An ounce of gold bought a fine toga in ancient Rome, a tailored suit 100 years ago, and it still does today. The currency units changed. Gold did not. When experts speak about gold reaching 5,000 or silver moving beyond 100, they're not predicting a miracle. They're acknowledging reality. They're recognizing that the currency system is being diluted at a pace that makes past numbers irrelevant. The higher the debt, the weaker the currency. The weaker the currency, the higher the nominal price of real money. This is not about timing the market. It's about understanding the difference between price and value. Once you grasp that difference, the noise fades and preparation becomes obvious. What the public sees and what actually happens inside the financial system are two very different realities. On the surface, you're told everything is under control. Inflation is manageable, growth is resilient, stability is returning. But behind the curtain, the actions tell a very different story. And if you know where to look, the truth becomes impossible to ignore. Central banks do not speak honestly. They signal through behavior. And their behavior right now is unmistakable. They are not increasing exposure to paper assets. They are not placing long-term faith in bonds that require dates of stability to be honored. Instead, they are quietly, consistently accumulating gold, not at a symbolic pace, but at levels that rival historic turning points in monetary history. This isn't speculation. Central banks don't speculate. They prepare. Their mandate is survival of the system, not returns, not growth, not public reassurance. When those institutions that create currency themselves choose to hold gold, it should tell you something profound about their confidence in the future of fiat money. Gold sits outside the system. It has no counterparty risk. It doesn't rely on another entity's promise to pay in a world drowning in promises. That makes gold dangerous, not to individuals, but to fragile financial structures. That is precisely why it has been dismissed, mocked, and suppressed for decades, because gold limits power, it exposes excess, and it cannot be printed to solve political problems. When trust begins to fracture, institutions act long before individuals do. They move silently because announcing fear creates panic. The public is reassured while positions are adjusted. History repeats this pattern every time. By the time average savers realize something is wrong, the exit is crowded and options are limited. The global landscape is changing fast. Trade is being restructured. Alliances are shifting. Reserve currency dependence is no longer assumed. It's questioned when nations begin settling trade outside traditional systems. They are not making a statement. They are managing risk. And gold is the neutral asset that allows that transition without dependence on another country's debt. People often ask why gold matters when everything is digital. The answer is simple. Digital systems are only as strong as the trust behind them. When trust weakens, systems freeze. Gold requires no electricity, no minim, no intermediary. It functions in silence across borders, across generations. That is not nostalgia. That is resilience. This accumulation trend isn't about short-term price movement. It's about long-term survival. Institutions are positioning for a future where confidence is scarce and credibility is priceless. And once that shift reaches the public consciousness, the repricing happens fast because there is not enough physical gold to satisfy both institutional and individual demand at the same time. When experts speak about dramatically higher gold prices, they are simply acknowledging what these actions already confirm. The system is being hedged against itself. And that tells you everything you need to know about where we are in the cycle. Silver is the most misunderstood asset in the entire financial system. It is treated like a speculative commodity, priced like an afterthought, and dismissed as too volatile to matter. But that misunderstanding is precisely why its role in the coming monetary shift is so powerful. Silver doesn't just sit in vaults. It gets used, consumed, and destroyed, and that changes everything. Unlike gold, which is primarily preserved, silver is essential to modern life. It runs through energy systems, technology, medical equipment, communications, and defense. Every solar panel, every advanced circuit, every high-efficiency battery uses silver because nothing else conducts electricity the same way. Once used, much of that silver is never recovered. It disappears into landfills, products, and infrastructure, gone forever. For decades, silver prices have been artificially restrained. Mining has been discouraged. Exploration has been underfunded. Production has lagged demand year after year. This wasn't a problem when industrial usage was moderate and inventories were ample, but that world no longer exists. Today, demand is structural, not cyclical. It is built into the future of energy and technology, whether prices cooperate or not. At the same time, silver carries a monetary history that predates most modern currencies. It has been money for thousands of years. It was never demonetized because it failed. It was sidelined because it limited limit. You cannot inflate silver supply at will. That makes it inconvenient for systems built on debt and growth at any cost. This creates a unique pressure point. When currencies weaken, people instinctively move toward tangible value. Gold absorbs the first wave, silver absorbs the next. But with far less available supply, the silver market is small, extremely small. It does not take massive demand to overwhelm it. When investment interest intersects with industrial necessity, pricing doesn't adjust gradually. It snaps. Volatility in silver is often used as an argument against it. In reality, that volatility is evidence of stress. Thin supply, heavy demand, and financial leverage create violent moves. But volatility cuts both ways, and suppression fails. Silver does not climb politely. It revalues abruptly. That has happened every time confidence in currency systems cracks. The idea of silver reaching triple digits sounds extreme, only if you believe the current system is stable. If you understand the mechanics, depleted inventories, rising industrial demand, monetary remonetization, and currency dilution, then triple-digit silver is not aggressive, it's conservative. There is also an accessibility element people overlook. Gold preserves large amounts of wealth efficiently. Silver preserves purchasing power at a more granular level. That makes it essential in times of monetary transition when trust is low and flexibility matters. Historically, silver bridges the gap between collapse and rebuilding. When experts talk about silver breaking past 100, they are not forecasting hype. They are recognizing a supply crisis colliding with a monetary reset. Silver is not just undervalued, it is structurally mispriced. And once the repricing begins, it doesn't wait for permission or consensus. Silver doesn't need belief to work. It only needs reality to assert itself. People want dates. They want a year, a moment, a clean event they can circle on a calendar. But monetary resets don't announce themselves with countdown clocks. They unfold through convergence when multiple long-term pressures collide at once. That is why the focus on 2026 matters, not because it is a prophecy, but because the math, the cycles, and the behavior are all lining. Debt cycles have limits. When debt grows faster than income, the system relies on confidence to survive. Eventually, confidence becomes the only thing holding it together. Interest costs rise, refinancing becomes harder, and governments face a choice they always make the same way: debase the currency or default openly. History shows they choose debasement first every time. At the same time, geopolitical trust is eroding, trade is fragmenting, supply chains are being regionalized. Currency dominance is being challenged not through speeches but through action. When nations reduce exposure to another country's debt, they are preparing for instability, and preparation always precedes transition. There is also a generational shift happening. Younger populations are questioning systems that no longer deliver stability, affordability, or opportunity. Social contracts are fraying. Political polarization is rising. These are not separate issues. They are on and all symptoms. When money fails to perform its basic function, societies destabilize. Technology adds another layer. Speed amplifies outcomes. Capital moves faster. Information spreads instantly. Panic, when it arrives, doesn't unfold over years like it once did. It happens in weeks, sometimes days, is designed for a slower world break under modern stress. Liquidity disappears before most people even realize it's needed. This is why repricing events feel sudden. They aren't sudden at all. They are delayed reactions to years of imbalance. When gold and silver move sharply, it's because the pressure finally exceeded the system's ability to contain it. Suppression fails. Confidence cracks. Reality asserts itself. 2026 represents a convergence point. Debt saturation, currency dilution, central bank behavior, industrial shortages, geopolitical realignment. These forces don't reverse easily, and they don't resolve gently. They reset, often violently, always decisively. When gold approaches 5,000 and silver pushes beyond 100, it will not be because something went right. It will be because the system did what it always does at the end of a cycle. It broke, and those prices will not represent wealth creation. They will represent purchasing power preservation in a weaker currency environment. The real question is not whether these levels are reached. The question is what those numbers will buy when they are. Will they preserve access to food, energy, shelter, and security? Or will they simply look purpose on a screen while real costs skyrocket? Preparation is not fear. It is responsibility. Understanding cycles is not pessimism. It is literacy. The future does not belong to those who hope the system survives. It belongs to those who understand what survives systems. Because resets don't ask for permission. And value doesn't negotiate with denial. So ask yourself one honest question, not tomorrow, not someday, today. Are you positioned for the system you hope will survive or the one history says will not? Because wealth is not what you earn, it's what you keep. And real money has always been the final truth. When everything else becomes a lie,